Whether you own one home or 40 properties, this episode is for you. Because the trap I'm about to show you doesn't care how many doors you own. It only cares where your money is trapped. Most people confuse ownership with control. They're not the same thing. I want you to listen very carefully to this.
At what point are we really gonna have the real conversation about buying real estate and whether you can really get rich buying single families, duplexes, quads? I'm talking about really living off of your cash flow, not having other businesses and other active income streams. But I personally had 40 plus properties and was still broke. Like, I was cash poor, equity rich. I had net worth and all this stuff on paper, but I wasn't able to live off of my cash flow if I didn't have other active income streams. Yes, I made cash flow month by month, but by month 7 or 8, when there's a snowstorm and the pipes freeze and they burst and I gotta replace the piping and I gotta replace the ceiling tiles and the flooring. Let's not talk about when the roof is leaking and we gotta keep spending money to patch things up and make things work. You spend $10,000, $15,000 to turn over a unit and then you rent out that unit for $2,000 a month. How long does it take you to get your money back? I'm talking about pure cash flow.
Now that's not failure. That's the home equity trap. If you're a single family homeowner thinking, that's a real estate investor's problem, it's not mine. Stay with me. Because the structure behind what you just heard is happening quietly in millions of American households. Here's why intelligent, disciplined people fall into this trap. You see, equity rises quietly, but liquidity gets tested loudly. As long as the number on paper keeps going up, we tell ourselves everything's fine, right? But preparedness isn't tested on paper. It's tested under pressure. According to Pew's Research Center analysis of the Federal Reserve's survey of consumer finances, about 45% of median U.S. homeowners' net worth is tied up in home equity. Pew also shows that Black and Hispanic homeowners' home equity represents nearly 2/3 of their total wealth. That means one asset in one location exposed to one set of risks. Now, this asset is carrying most of the financial confidence in America. You see, that's not diversification, that's concentration. Now, let's look at the other side of the balance sheet. According to the Federal Reserve's 2024 Economic Well-Being of U.S. Households report, nearly 48% of adults say the largest emergency they can cover with savings is $2,000 or less. Now, that same Federal Reserve report shows that about 1 in 5 Americans can't even cover $100 with savings. And Bankrate's emergency savings report confirms this pattern, showing that only 47% of Americans say they could handle a $1,000 emergency. So we've built balance sheets that look strong and lies that are financially brittle. So let me pause right here, because this is usually the moment people realize this isn't theory, this is actually personal. I relate with this. A lot of people watching this don't need more content. They need clarity. They need specifics to their situation. That's why I make myself available on an app called Connect. Connect isn't a course, it's not a funnel, it's not a sales call. It's a one-on-one conversation where you and I can look at each other and see where your wealth is concentrated, where liquidity is thin, and where control may be leaking without you realizing. Some people come as homeowners. Some people come on board as real estate investors to this app. Some come because something feels off. They can't put the language to it or articulate it. Now, if that's you, you can book time with me directly on Connect. Scan this QR code right here, and let's keep building the framework to your financial control. Now, here's what most people misunderstand about home equity. They assume access will always be there. It's not. According to research summarized by the Federal Reserve and mortgage analytic firms like Black Knight, access to home equity is highly cyclical. In strong economic periods, lending is loose and equity is easier to tap into. But in downturns, like the 2008 financial crisis, remember that? Underwriting tightens, loan-to-value limits drop, credit requirements rise, and HELOCs, home equity lines of credit, are frozen or reduced. This pattern is well documented in Federal Reserve research on credit cycles. The moment people need access to the most is usually the worst possible time to touch equity. It's often said, when you need the money, you can't get it. You don't need the money, you can get it. Now let's go back to what you just heard at the beginning of this episode. That real estate investor didn't lack assets. What he lacked insulation. Every repair, every vacancy, every unexpected expense forced him to touch the very asset that he was counting on. See, that's not passive income. That's deferred stress boxed up in property. Single-family homeowners experience the same thing, just without 40 doors. You need to replace the roof. They got an unexpected medical bill. They got a job interruption. They want to help a family member. And see, that's when people realize their home made them feel wealthy, but didn't make them financially ready. And here's the part most people don't want to hear. The problem isn't real estate. The problem is using real estate as your emergency fund. In my best-selling book, Keep the Keys, I teach that insurance is not just about return. It's about response. It's about having money available without having to sell your property, refinance under pressure, or taking on more debt when life is already financially unstable. Now, growth money is real estate. It's long-term and illiquid by design. Now, shock money is what shows up when life punches back. If your only source of shock money is your house, you don't have a plan. You've got to gamble. And this is where properly structured life insurance matters. Yes, I said it, life insurance. Because wealthy people know that life insurance is not just for dying, it is also for living. Because insurance creates contractual liquidity. Not because markets are up, not because banks feel generous, but because it was designed that way from day one. That financial liquidity becomes the buffer between you and your real estate. Let me give you a real estate example, real time. One of our mortgage strategists, trained in the Keep the Keys methodology, had a client. They needed a $200,000 cash out refinance from their home equity just to keep his business afloat. By the time I got involved, this homeowner wasn't thinking strategically anymore. He was reactive. He was desperate. He was only focused on solving today's problem. But for 8 years, he had been aggressively sending extra mortgage payments to accelerate the payment of his house. Thankfully, the housing market cooperated and his equity grew. But all that discipline, all that sacrifice compounded linearly. It stayed illiquid though. That equity was trapped inside his house. Now, if he had built that same equity outside of his growth asset, inside of a control asset, hint, life insurance, properly structured permanent life insurance policy, he would have had liquidity, he would have had options, and exponential compounding return instead. Instead of begging the bank for access to his own equity, he could have decided calmly how to deploy his capital. Here's a part that most people miss. In his rush to do a cash out refinance, he expanded his mortgage debt once again without increasing his life insurance coverage. Think about that. He insured the house, insured the lender's collateral, but he forgot to insure the source that pays for all of it. What's that? Himself. This isn't judgment. This is proper sequencing. Now, insurance doesn't compete with real estate. It actually protects the real estate. It allows you to cover vacancies, repairs, and income disruptions without having to sell assets or break long-term leverage. Now, if this is starting to click conceptually, the next step is getting it out of your head and onto paper. I wrote the book, Keep the Keys, because too many people were making big financial decisions without a framework. And because they were reckless, because no one ever taught them how to think in terms of control. Now, on my website, you can get the book, but you can also get 2 free tools, which are the Keep the Keys scorecard and the Clarity worksheet. This will help you map where your assets and where they're concentrated, where liquidity is thin, and where you may be over-relying on your equity. You'll find everything at the QR code, so scan this and get access to your free tools from Keep the Keys. Now, equity isn't bad. Real estate isn't bad. But confusing equity from control, now that's bad. Leaders don't measure wealth by how big the number looks on paper. Measured by how fast they can respond, how many options they preserve, and how little they have to disrupt their plan, especially when it's stress tested. And one last thing, because some conversations are meant to stay on the screen. On February 12th, we're hosting our next Cigars, Wealth, and Whiskey event right here in Frisco, Texas, at the official lounge of the Cigars, Wealth, and Whiskey event, which is an industrial cigar company right here in Frisco, Texas. This isn't a conference. It's not a pitch. It's a table. We'll be joined by Jeff Karcher, a global strategy director of the Texas Stock Exchange, for a special interview amongst those in the crowd. And for those purchasing elite level tickets, guess what? Jeff is joining us for dinner right before we start the Cigars, Wealth, and Whiskey event. As of now, there are only 7 elite tickets left. So get your tickets by scanning this QR code below. Let me leave you with this. Most people don't lose control of the money all at once. They lose it gradually. They lose it by building wealth in places they feel good, but yet they don't respond well when they're under financial pressure, and by assuming access will always be there when they need it. And what you saw today, from the real estate investor with 40 properties to the homeowner still sitting on years of trapped equity, This isn't a failure of discipline. It's a failure of architecture and how the finances were built. See, real estate is a powerful tool, but real estate was never meant to be your emergency fund, your liquidity plan, and your income protection strategy all at the same time. See, that's where control breaks. See, leaders, when they think about this, they think about it differently. They separate growth from protection, confidence from readiness, net worth from actual control, and they build systems that don't force them to sell under stress, to borrow under pressure, or make permanent decisions, sadly, in temporary situations. If this episode stirs something in you, that's not fear, and that's awareness. If you want to take this next step, start with clarity, not action. Go to my website and download your 2 free tools to keep the key scorecard and the clarity worksheet. These tools will help you see on paper where your assets are concentrated, where your liquidity is thin, and where control may be leaking. No hype, no sales pressure, just your truth. If you already know, I don't need more content, I need direction, you can book time with me directly on Connect. And that's where we talk through your balance sheet, your blind spots, and what control actually looks like in your situation. This QR code will send you right to my app profile on Connect. Last but not least, for those of you who value real conversations, not just for information, on February 12th, we're gathering in Frisco, Texas. Get your tickets for Cigars, Wealth, and Whiskey. Again, this isn't a conference. It's a table joined by Jeff Karch. I believe this might be his first public interview from the Texas Stock Exchange. And for those of us joining at the elite level, we'll have a more in-depth conversation over dinner. There are only a few elite tickets left. Again, details are in the QR code. Scan it right here to get your tickets. To wrap up, wealth isn't about how much you've accumulated. It's about how well your system holds up. When life applies pressure, control isn't something you chase later on. It's something that you do right now. That being said, from Dallas, Texas, I appreciate you tuning in. Smash that like button, smash the subscribe button, and please put your biggest takeaway in the comment section below. I'm your money smart guy, and until we meet again, continue to live smart, continue to love smart, and be money smart today.